Welcome to the April review of markets. I'm James Godrich, and April was a very volatile month with markets starting the period going down quite a lot and then recovering during the second half. And I'm here with John Cunliffe, the head of our investment office, to talk a little bit more about it. So, John, why don't you start off by giving us a quick recap?
Yeah, April was very volatile. We started the month with Donald Trump announcing tariffs on pretty much all of the major trading partners of the US in terms of US imports. And the effective tariff rate, if those were implemented, would have been as high as 25%. That would be the highest tariff rate that we'd have seen since the First World War. Clearly very disruptive to the global economy, giving all sorts of questions around what can be done to sustain the global growth outlook. And with that, that was the backdrop that we saw.
Yeah, and I think what's interesting is there's a lot of market impact there as well. So we saw equities down quite a lot. And so in the first 4 days of the month, I think the US market was down by nearly 10%. But as well as that, we saw bonds being weak. So we saw interest rates or yields on government debt, which went higher during the period. But we also saw the dollar weaken. So it was really quite a kind of toxic cocktail, and something that we quite rarely see. And so I think, when you see that kind of big, strong move, that can't not feed back into policy. And I think we did see that, didn't we, over the period?
Yeah, and in an environment where market volatility is elevated, typically the US dollar and US treasuries tend to do well. This time round, they didn't. And I think it was because the markets were questioning the credibility of the Trump administration's approach to trade policy. And as a result of that, Donald Trump had to row back on some of the tariffs that he announced, the reciprocal tariffs, for a 90-day period to allow some time for the US administration to begin some trade talks with its key trading partners and try and buy a bit more time.
Yeah, and I think what we ended up seeing was equities recovered in the second half, as I kind of mentioned. And so when we look at the performance over the whole period, actually it doesn't look like a lot happened. Portfolios were broadly flat over the period, but actually there's a lot to talk about, and there's a lot that we saw, within that. One thing that I probably would pull out is that whilst we saw equities recover, what we did see is the US dollar continue to weaken over the period. And so from that perspective, our underweight position to North American equities was a beneficiary on a relative basis. And I think it kind of still continues with the theme of the broadening out of markets and the broadening out of returns. And maybe I think it's worth just touching on that and thinking about how we're looking at the outlook for maybe the rest of the year and going forward.
Yeah, and I think the dollar over the last 15 years has generally been a tailwind for investors in US assets, particularly the US equity market. I think now it's more likely to be a headwind, certainly is to be borne in mind, and that does support our positioning within the US equity market. I think as we look ahead, it's perfectly reasonable to expect two really quite soft quarters of growth, particularly in the US, and obviously some adjustment higher in terms of the price level as well to reflect the effect of tariffs. But we also see some pretty good policy support, both in terms of government spending in a number of regions around the world, and also in terms of central bank rate cuts. And both of those are likely to be positive for the next 12 to 18 months on equities, particularly as we head towards the midterm elections in autumn next year, where Donald Trump will be very keen to try and get the economy back onto the better footing and get markets higher again. So that's really the backdrop. But I think in the near term, particularly as we head towards the ending of this 90-day pause period, which I think is about the 8th of July on the reciprocal tariffs, expect more volatility, certainly until we get through that period and we get some more clarity on trade policy.
Yeah, so really, not a lot at the headline level when we look at portfolio returns, but quite a lot going on under the bonnet and lots to think about as we look forward to the rest of the year.